Namaste to you, Sharad ji, and a very warm welcome. After months and months of pain, you have this mild, brief spark of happiness on the Lal Street. How are you reading sentiment?
Well, I think as you rightly mentioned, the broader imprint is very positive, whether it's the rating improvement, some resolution probably on the US tariffs also. I think the first 25% was something we took in our stride. The second 25% is that hits us hard. The only point that I'm afraid right now is probably, that with this GST cut or rationalization, as whatever way you call it, I think with this being already announced, maybe the green shoots of consumption that we were expecting in a lot of spaces, it might be, kicked down the line for around 2 to 3 months, around the time by when these announcements fructify. So that could result in this, consumption revival that we were expecting across the board. General consumption, yeah, that will continue to be there, but I think the high ticket items, which are consumer durables, autos, I think that might be kicked a bit later in the year. So that is one probable risk that might lead to a non-challenge, non-interesting kind of market for the next maybe 2 to 3 months in terms of macro data. But yeah, in the long term, I think the indications are very positive. 1 year, 1.5 year, even 6 to 9 months. I think most of these should fructify into very positive developments. The NBFC relaxation, the liquidity in the system. I think largely everything is positive. Maybe the consumption juggernaut, takes shape maybe 2 to 3 months later than what I was expecting. That's the only risk point.
I think that's very well described. I think uh, all uh, all necessary conditions for a strong second quarter have been met. We've had a 100 basis rate cut by the Reserve Bank of India in the last 4 months or so. That has made credit cheaper. We've had an income tax bonanza coming in the budget in February. That's given rising disposable income. And with these recalibration of GST rates, a lot of household items such as, cars, bikes, brown goods, FMCG, all of them are going to get cheaper, so money is going to go longer. That, of course, is going to spark a consumption boom. At least that is what theory says. Now, let's get to Sharadji and try to understand what his research team has come up with. Sharadji, with a very busy weekend that I'm sure you would have had because of two major developments, now tell us what has your research team thrown up in terms of top picks because of these two changes, a ratings upgrade and two, GST recalibration.
I think this GST recalibration is something that will certainly be positive for autos, particularly two-wheelers and four-wheelers. And as you rightly mentioned, the tax cut is also something that would be very favorable for two-wheelers. So I think the two-wheeler auto ancillary story is very strong. I think even the defense stocks after this correction, they look like a very decent bet. Not really connected to this, but connected to this, I think the two-wheeler story is very attractive. Within FMCGs, you could do a bit of pick and choose. So something like a Jyoti Labs, Dabur India, the second lines, maybe the likes of Honasa, etc., could be very good bets that we are looking at. Because in addition to all the things you mentioned, I think even the pay commission effect will also be there, so that adds another consumption boost. So most probably, across the board, maybe FMCG with select choices. The frontline FMCGs, I still think the valuations are a tad on the expensive side, but something like a Dabur, Jyoti Labs, Honasa, these could be good ideas. On the two-wheeler side, I think Hero continues to be our top bet. That continues to look like a very good idea to us. And even I think real estate could be something that could be making a comeback. So maybe the frontline names, they might be a tad on the higher side. But there are companies like Keystone Realtors. We are looking at Suraj Estate, Shriram Properties. So these could be good ideas you could look at.
If you like the video, do like, comment, share and subscribe.